Thank you for joining me. I'm Gord Long. A reminder before we begin, do not trade from any of these slides. They are commentary for educational and discussion purposes only. Always consult a professional financial advisor before making any investment decisions. In this month's LONGWave video, I'd like to discuss what is driving the COVID-19 market rebound. The market appears to be disconnected from the economy, but is this actually the case? Does the market see something that as of yet the economy is not signaling? We will endeavor to shed some light on this current quandary. As such, I'd like to cover those items listed here. Let's start with what is occurring, and is this typical and something we should be expecting? The market was in a tenuous position prior to the onset of the COVID-19 pandemic. The repo turmoil in the fall signaled all was not well in the funding market. Valuations were at historic levels and breadth was rapidly deteriorating, so that only 6 stocks were supporting the market basically. This was not altogether too dissimilar to the lead up to the dot-com bubble implosion in 2000. Additionally, we were at the end of the longest U.S. economic expansion in history going into the COVID-19 pandemic scare. These and other issues suggested we had all the ingredients of a cyclical pullback in markets. Then COVID-19 hit and we locked down the global economy, creating the largest global demand and supply shock in history. The market obviously crashed and in a heartbeat has surprisingly retraced a significant amount of its losses. So is this chart really representing what we are experiencing? Or was this only a bump in the road to higher market highs? Less than 3 months after the markets were gripped by a historic bout of panic, dumping everything, bonds, stocks, gold, Bitcoin in a liquidation frenzy, euphoria on Wall Street is back to levels not seen since the dot-com bubble, at least according to Citi's panic euphoria model, prompting the bank to warn that bullish investor positioning, which now also includes hedge funds, in addition to retail traders, may be overly extended and investors may not be factoring all the potential risks in. This was also reflected by Bloomberg, and I quote, "The market plunge and rebound in such a short period of time has left many investors scratching their heads in confusion. Those who held on to their equity assets have ridden the stock market roller coaster and almost back where they started, while those who sold are feeling upset, and the ones who bought in the eye of the storm are richer." End of quote. All of this is taking place even as Citi writes that its model still shows that more than a 70% probability of a down market in the next 12 months remains, which in turn prompts Citi to attempt to explain that just like the payrolls report, the bank's panic euphoria model may have been distorted, as soaring trading volume numbers have been a significant factor in the more jumpy revisions of this sentiment metric. What I see is that the equity markets have simply went full in on reconnecting with the Fed's balance sheet growth in what has been the winning strategy since at least 2018. I also see that our 1929 analogy, which has worked so well since the fall of 2019, has broken down, as markets with the aid of a suspicious May non-farm payroll report have surged higher. The surge has pushed through our upper reversal level target of 3140 on the S&P 500 and appears destined to want to fill the unfilled gap which kicked off the COVID-19 crash. However, we need to fully appreciate the unprecedented amount of liquidity the Federal Reserve has pumped into the system. It has abruptly taken its balance sheet from just over $4 trillion to approaching $7 trillion, with Congress inserting an additional $3 trillion approximately. As this chart we showed in a recent video suggested, we should have expected the markets to power higher to match the May 20th level shown in dark blue and reflecting the growth in the M2 ratio and the S&P 500 market cap before rolling over and heading lower in line with the 252-day trading day leading indicator used here. So what is going on in the head of the traders and institutional investors other than the old adage, just don't fight the Fed? Traders and computer-controlled trading algos are clearly violently working the markets. Volatility is their opportunity. On Friday, it manifested itself in the highest NASDAQ volume in history with the release of the suspicious May non-farm payroll numbers, When we remember this is a U.S. election year, and historically government statistics seem to always favor the existing administration's policy results, the BLS's plug number may not be that much of a surprise. The rate of change of the COVID-19 rebound has been historic. The break above our initial 200-day moving average rebound target triggered a parabolic advance in the market over the last week. The market is making a 3 standard deviation move to the upside. Any attempt to stand in the way of this bounce has been smashed relentlessly, as the algos specifically target any and all hedging and short attempts. This has been the game of traders since March 16th, which kicked off the counter rally. The most shorted stocks have collectively soared approximately 88% from the March lows shown here. You can see this correlated with the highs in the VIX. Now we see call buying leveraging the market higher. Frankly, it is all the earmarks of a controlled pump and dump operation to me. The market is not forward-looking, but is blindly chasing liquidity, and by doing so has blindly gone vertical and embraced an unsustainable path of historic valuations, overly reliant on overnight unfilled gaps. The market's moves are primarily found in overnight gaps, a path that keeps building risks of future gap fills to the downside, especially in the context of ever-tightening price patterns, not only in the market charts, but also the VIX. Our March 16th date also correlates with a steady retracement of the prior sudden surge in dollar gains. People paid up then for dollar security in a flight to safety as the markets crashed. Now, as the dollar falls, it is taking more dollars to buy the same crippled basket of stocks. It was like igniting afterburners to the market, desperate to find a safe home for their newly purchased dollars. With the yield curve suddenly abruptly steepening, the equity markets for institutions was the place to at least temporarily increase portfolio weighting. Remembering portfolio managers buy opportunity because they have to. If they don't, they suffer career risk, plain and simple. They are paid to invest. Also, remember, it is other people's money they're investing, not their own. However, you don't have to. If you are indeed a long-term investor, you have to question the risk undertaken to achieve further returns in the market as we currently see it. With 6 major technology stocks being the safest place to move, they took the markets higher. These 6 stocks are held in almost all indexes and dominate holdings in a vast amount of popular ETFs. The rebound would have been below our 1929 rebound analogy without these 6 stocks. Is it any wonder the market suddenly exploded higher? I think this illustration best pictures what is unfolded as a result of these factors at play. The question is whether it is sustainable, or is it just as likely to abruptly reverse? That is likely to have a lot to do with the rate, and I stress rate, of liquidity injections. For those who remember their calculus, it is the first-order derivative here that matters. This is not about the absolute levels of the global central bank's balance sheet, but the rate at which they sustain liquidity rates, and then whether they increase or decrease those rates. In the past 8 weeks, central banks have been buying $2.4 billion per hour of financial assets. This rate of increase is obviously difficult to sustain and highly likely not to be. We are showing here the global liquidity proxy versus just the Federal Reserve balance sheet, which we showed earlier. It is the global liquidity proxy that is currently important. The amount of QE purchases implemented and new credit facilities announced has accounted for around 55% of all measures across the G20 and 60% of the $4.5 trillion increase in G10 central bank balance sheets. This share will likely gradually ease over time as the Fed's aggressive pace of QE is easing, while intervention in other countries, such as the newly discounted TLTRO III in the euro area, are yet to come online. Relative to the size of the economy, the Fed and the Bank of Canada have seen the largest increase in their balance sheets since the COVID-19 shock, with a 12 to 13% of GDP increases since the end of February compared to rises of 6 to 7% across the euro area, Japan, and the UK. As the consensus 12-month forward earnings per share forecast graphically illustrates on this chart, equity markets are no longer connected to the S&P 500 stock valuations. Forecasts are roughly 142 at the moment for 2020. Even if profits jump to just north of 160, which would be near 2019 profits, we have forward PE multiples now already well over 20 times. Valuations leave little chance of being even close to historically reasonable. All this assumes corporate tax rates do not move higher, something that would happen should Biden defeat Trump and the Democrats sweep Congress. Then there is the expectations of COVID-19 containment, plus vaccines that are ready to go and inoculate tens of millions of people rapidly, which seems difficult given how poorly the testing has gone. Can the markets continue to disconnect from the economy at an ever-widening gap? I remember young traders arguing vehemently prior to the dot-com bubble bursting that market fundamentals were meaningless and only how old, obsolete men viewed the market. I'm hearing the same thing again. This time the refrain is the only thing that counts is liquidity. But is this true? Liquidity can potentially delay the turn in business cycles and even reduce to some degree its full impact. However, central banks have never been able to halt it. We have just completed the longest period of economic expansion in U.S. history after 128 months via historic liquidity injections and extreme leverage buildups, and yet expect the cycle to continue after the worst global demand and supply shock in history? It seems we are asking an awful lot of our central banks without them completely destroying already fragile and brittle global economic imbalances. An engineered V-shaped recovery in stocks does not mean a V-shaped recovery in the economy. Demand destruction is enormous. The Congressional Budget Office estimates it will take 10 years just to get back to even. Bank of America's latest fund manager survey, which polled 223 participants with $651 billion in assets under management, showed the vast majority of financial professionals remain incredibly bearish on the global economy. Respondents do not expect global manufacturing PMI to rise back above the contraction level of 50 until fourth quarter of 2000 at the earliest. Everything would indicate we are facing an L-shaped economic recovery. This means bankruptcies, layoffs, tightening credit, sustained levels of higher unemployment, and reduced consumption from both the consumer and businesses. That's what comes with a recession. The simple fact is that liquidity and stimulus doesn't fix nor address solvency. The supply side story in Asia is yet to be revived because the demand story in Europe and North America is offline. Without Western demand, reviving Asian factories will not be possible. Thus, world trade won't rebound as quickly as everybody is currently believing. It could take several years or more for global GDP to recover back to even 2019 levels. How do the central banks justify goosing markets and reacting to market swoons with increasing liquidity rates when PE ratios are going off the charts? Markets closed last week at a red flag screaming 151% market cap to GDP for the S&P 500, while the Wilshire 5000 was at 163%. There is no history, none, that shows valuations above 150% market cap to GDP are sustainable. None. Somewhere the bigger fool theory of bubbles suggests that soon fewer and fewer bigger fools will be found to keep this market going higher. As we opined in the latest Under the Lens video, we have begun a secular shift in sentiment. Remember, however, there are many smaller cyclical cycles within a larger secular cycle. We are in the midst of a smaller one now as markets have moved up from extreme low levels at the lows of the initial COVID-19 market sell-off. The longer view shows how this fits. The worst is still to come as liquidity and stimulus has failed over the last 40 years to stop the GDP trend from continuing to fall, as shown in the bottom panel in red. The key issues in my assessment to watch are the following. I have showed this proprietary MATA SII yield curve analysis before, saying to wait for the second yield curve steepening. It is then that markets begin to react in a sustained fashion. Prior to that, it is the world of traders, speculators, and manipulation. After that, it is the reality of the economy and the world where investors actually live. The U.S. Treasury yield curve, as represented by the spread between the 10 and 2-year yields, expanded or steepened to around 72 basis points on Friday. to hit the highest level since February 2018. The curve steepened by 25 basis points last week and over 10 basis points on Friday alone, and is indicative of growing optimism in the economic recovery among bond traders. Friday's U.S. non-payrolls report showed the economy added 2.5 million jobs in May, pushing the unemployment rate lower to 13.3%. Wall Street economists were looking for job losses of around 8 million. The data has revived the talk of a V-shaped economic recovery in the U.S. While high growth expectations are lifting long-term yields, the short-term yields are lagging due to the Federal Reserve's pledge to keep interest rates near zero for a prolonged time. The Fed is highly likely to be forced to ease pressure on long-term yields via soon-to-be-announced yield curve control, where it essentially pegs long-term yields via forward guidance and by buying long-term bonds to maintain the peg. This is now being discussed and is likely to happen sometime in the September timeframe. The Bank of Japan has been doing this for years. To dodge this, Japanese banks, pension funds, and other entities have chased yields overseas. This has turned Japanese banks into the most fervent buyers of collateral loan obligations backed by junk-rated leveraged loans issued by the over-leveraged U.S. companies that are now toppling. Yield curve control has insidious side effects, and in an inflationary scenario, yield curve control would make treasuries as unappealing for long-term bondholders as a toxic waste dump. The dollar's recent weakness may be the market smelling this and consumer inflation. The amount of supply hitting the market, in addition to rollover, is significant. The U.S. Treasury is expecting to dump over $700 billion of treasuries on the market over the next 3 weeks. We may get a push towards our pink target overhead resistance band during this period and before the Fed initiates its new yield curve control initiatives. More ever-increasing levels of desperation experiments, which will unnerve investors on whether the central banks still have control of the markets. Traders and investors know only too well that when real rates increase 25 to 50 basis points on a quarterly basis, it is usually a bad sign for equities and time to go risk off. The put-call ratio is strongly warning of a potential pending risk-off event. So what can we conclude? The one thing we know for certain is liquidity injections and fiscal deficit stimulus spending have not fixed any underlying economic problems. You need not look any further than the slope of the velocity of money chart. The velocity of money should be steady to marginally sloping upward in a healthy economy. Weakness indicates slowing economic conditions. Since the dot-com bubble, it has steadily crumbled as more and more liquidity and stimulus was continuously injected to keep the economy effectively on life support, but without any fix to what ails economic growth. Eventually, all this money will be seen to have been a waste and a very expensive impediment to any real economic rebound. We're likely in what might be described as a Wile E. Coyote moment. People are ignoring joblessness, trade frictions, a widening wealth gap, social unrest, and risks loom, including possible COVID-19 reinfections, the end of bonus supplemental unemployment checks, the upcoming election, the risks of a building record rift between asset prices and the real economy. I can't help but be concerned that thoughtful approaches are being overwhelmed by the need to at least keep pace with the current price movements. Let me close by showing the 6 stages I expect to unfold, which eventually will take the markets lower. And I say eventually. It is stage 5, when the wealth effect reverses. That is the most concerning. I encourage you to review the macro analytics video, The Reverse Wealth Effect, which I just released with Charles Hugh Smith for further discussions on this subject. It is important to remember, and what I've expressed in previous videos, that if the market doesn't correct and start to correct fairly significantly, then we have clearly crossed the Rubicon. And I outlined this in the video entitled Regime Change. That is, that markets are now completely controlled artificially by Fed stimulus, and that the economy and market disconnect will continue to rise. This will lead to more and more programs from the Fed to keep this happening, of levels of guarantees and nationalization of pensions, etc. It's only a matter of time, if in fact we've crossed the Rubicon. Indications are that we have, and therefore markets cannot be allowed to fall. So everything I said could go by the way if they keep this rate, and remember it's the rate of increase of liquidity increasing. That is the factor to watch, that rate. Otherwise, the factors we've just outlined will take control, at least in the short term. As I always remind you in these videos, remember politicians and central banks will print the money to solve any and all problems until such time as no one will take the money or it is of no value. That day is still in the future, so take advantage of the opportunities as they currently exist. Investing is always easier when you know with relative certainty how the powers to be will react. Your chances of success go up dramatically. The powers to be are now effectively trapped by policies of fiat currencies, unsound money, political polarization, and global policy paralysis. I'd like to take a moment as a reminder, do not trade from any of these slides. They are for educational and discussion purposes only. As negative as these comments often are, there has seldom been a better time for investing. However, it requires careful analysis and not following what has traditionally been the true and tried approaches. Do your reading and make sure you have a knowledgeable and well-informed financial advisor. So until we talk again, may 2020 turn out to be an outstanding investment year for you and your family. I thank you very much for listening.